Mark Humphery-Jenner. He's an Associate Professor of Finance at the University of New South Wales Business School. Now, going back to Malaysia and India, Malaysia handles the assembly side while India leads on design. Does that make this a dream team that can rival China's efficiency, or is it more of a diplomatic safety net?
Well, firstly, thanks for having me. And with any of these deals, there's often a lot of complexity, particularly when you involve two countries and potentially a degree of duplication of what's being done. And you, in essence, need to have both countries and companies within both countries cooperating, which can be easier said than done when there are fears about intellectual property enforcement and the like. Now, this, of course, is ultimately going to be good for both India and Malaysia, but whether it really causes them to dominate or move up the charts in terms of semiconductor production isn't totally clear. Well, so if we look at the market share for semiconductor production, for example, well, there's a notable top 5 and a big drop-off from there. And while Malaysia is currently in the top 10 in terms of the number of fabrication plants, it isn't there in terms of market share, and it has its work cut out for it. Now, this deal, of course, will help things, and it will help to cement ties between the countries, but again, it's not going to be an immediate fix for either country or an immediate movement in terms of how much semiconductors are really being produced.
Right now, with the US threatening tariffs under Section 232, can this regional loop with India provide enough of a cushion if Malaysia loses its 0% exemption?
Absolutely. So say, for example, India is looking for additional trade partners. Well, having additional trade with Malaysia is clearly going to be helpful. So let's put this in perspective. The bilateral trade last year was about $18.6 billion between Malaysia and India. However, they're still relatively small in terms of the total trade package between each other. So to give you an example here, for Malaysia, well, India accounts for both about 3% of its exports and just under 3% of its imports, telling us there's a long way to grow. Now, in terms of the semiconductor deal, but also broader cooperation between the two countries, that absolutely is going to help somewhat cushion the blow if, for example, the United States were to impose more tariffs or there are more trade issues in relation to either Malaysia or India. However, the US is still a significant trade partner for both, and it's incredibly difficult to replace the impact of the United States just through this type of bilateral trade. After all, both economies are smaller than the United States, so if the United States is either cut off or made more expensive, it is going to still have a significant impact on both economies.
And we're seeing a push to de-dollarize trade here. Do you think it's a realistic move within the highly globalized semiconductor market, or just political signaling against Donald Trump's policies?
So there's been a push for de-dollarization for a little while, and it depends on which part of the globe we're looking at as to the exact driver for this. Often it's a movement to try to avoid being too beholden to US trade policy or economic policy, or potentially beholden to assets being frozen. There are, however, some challenges with de-dollarization. The main challenge is you need to find an alternative that is not impacted by inflation. Now, the United States has had inflation that is too high, but the Federal Reserve has really tried to focus on getting inflation back down toward target. Some other countries aren't quite as assiduous about this. So I'll give you an example. I'm based in Sydney. Australia's inflation rate recently came in at 3.8%. So it would be implausible that you would replace the US dollar with the AUD because Australia has significantly more inflation, but it's also a much smaller economy. And that type of issue holds for many economies outside of the United States. You also have the issue of, if you're replacing US control, what control are you replacing it with? For example, would you be better off generally as a counterparty trading in rubles or RMB? After all, RMB might be better for China and rubles might be better for Russia, but they're not necessarily better for the counterparty. And indeed, the United States dollar might be better for that counterparty. So unless they solve some of those issues, it is going to be incredibly difficult to replace the United States dollar as effectively a global, almost middle ground currency that both counterparties in trade are at least relatively open to using.
All right, we will leave it there for now. Mark Humphery-Jenner in Sydney. Great to have your thoughts. Thank you.